This is an emergency broadcast. Stop what you're doing right now. A major North American bank just turned off the silver buy button. Not a glitch, not maintenance, a complete shutdown. While you're watching this, the price gap between East and West just hit $9 per ounce. This isn't a market move anymore. This is a market fracture. And what I'm about to show you will change everything you thought you knew about silver. Welcome to Bullion IQ, where we decode the signals the financial system doesn't want you to see. It's Monday, January 26th, 2026. Silver is trading near $114 per ounce. But here's what they're not telling you. The price doesn't matter anymore. The price is just a number on a screen that tells you what you'd pay if you could actually find metal. Today, the if became the biggest problem in the global financial system. The story isn't about price. It's about availability. It's about the buy button disappearing from the banking system itself. We've just received confirmation of a development that signals the end of the retail silver market as we know it. TD Precious Metals, the bullion division of TD Bank, one of the largest financial institutions in North America, has officially suspended all sales of physical investment silver. Let that register for a moment. We're not talking about a local coin dealer in the Midwest running out of inventory. We're not talking about a website crash from too much traffic. We're talking about a Tier 1 bank, a bank with trillions in assets, a bank sitting at the center of the global financial web. As of this morning, if you log into their precious metals portal, you won't see a price. You won't see an add to cart button. You'll see a grayed out screen with a banner reading temporarily unavailable. The mainstream outlets, CNBC, Bloomberg, the usual suspects, will try to spin this. They'll call it a logistics issue, a supply chain delay due to overwhelming demand. They're lying. This isn't logistics. This is a bank run. But it's not a run on cash. It's a run on real assets. And the bank has nothing left to give. To understand why a giant like TD suddenly went dark, why they pulled up the drawbridge and locked the gates, you need to understand the catastrophic trading decisions they made over the last 6 months. You need to look at the short position. TD Bank didn't just facilitate the silver market. They gambled on it. They bet against you. Back when silver was at $40, their proprietary desk looked at the charts and said, "This is a bubble. Retail is wrong. Let's short it." They initiated a massive short position, selling paper silver they didn't own, betting the price would crash back to $30. They were wrong. The price ripped to $50. Did they cover? Did they admit the error? No, they're bankers. They doubled down. At $74, they shorted again. They threw millions in paper contracts at the rally, convinced they could suppress price through sheer force. They thought they could break sentiment, but they forgot one thing. You can't print silver, and you can't short a market being vacuumed dry by 1.4 billion people across Asia. The market ran them over. We have access to the trade data. We know exactly where the pain hit. TD Bank was finally stopped out at $90.50. The margin desk tapped them on the shoulder and said, "Game over." They were forced to buy back contracts at the peak, locking in losses of tens of millions. But the financial loss isn't the real disaster. Banks lose money constantly. The Fed just prints more. The real disaster is opportunity cost. Think about it. For 6 months, instead of stocking their vaults with physical bars and coins, instead of building inventory to sell during the biggest boom in history, they used capital to fight the boom. They wasted ammunition shooting at a tidal wave. Now, with silver at $114, they're standing there exposed. No metal, empty vaults. And they can't restock because the wholesale market is broken. They can't call refiners and say, "Oh, send us 10,000 ounces," because refiners are sold out until 2027. So they had no choice. They turned off the website. They suspended sales. They're burning in a fire of their own making. This is the retail collapse. The moment the paper window slams shut. For years, seasoned investors warned, better a year early than a day late. Well, it's now a day too late for TD customers. If you have cash in a TD account and want to convert it to silver to protect against inflation, the bank is telling you, "We can't help. Your money is trapped. You can see the number on your screen, but you can't turn those dollars into the only asset that matters." You're watching the rocket launch while holding a boarding pass for a canceled flight. And don't think TD will be the last domino. TD is just the first major institution to publicly admit defeat. But every other bank with a precious metals desk is facing identical math. They're all short. They're all unhedged. They're all running on empty. We're witnessing the systemic removal of liquidity for retail buyers. The sell button is being deleted from the interface of the global economy. Soon, you won't be able to buy from major banks. The only place you will find it is from the individual who had the foresight to stack 5 years ago. And they're not selling for $114. They're not selling for $500. If you're sitting with cash, waiting for a pullback, waiting for a dip to buy cheaper, you're playing a dangerous game. There's no dip coming. There's only sold out, only suspended. Only the silence of banks with nothing left but worthless paper. But if you think the panic at retail is severe, What's happening on Wall Street right now is a bloodbath. Retail banks are closing doors, but the investment banks, the apex predators of finance, are starting to consume their own. We've just received confirmation that the first major figure has exited at the most powerful bank on the planet. We need to talk about Goldman Sachs. We need to discuss why the head of precious metals trading suddenly left during the greatest trading week in history. You don't quit when you're winning. You quit when you've destroyed the account. While retail investors bang on TD's locked doors screaming for silver, something far more revealing is happening in the towers of Manhattan. We've moved from retail collapse to institutional purge. The first general of the paper army has fallen, and the silence from Wall Street is deafening. We've received confirmation from multiple industry sources. Benjamin Benny Lane, global head of precious metals trading at Goldman Sachs, is no longer with the firm. For those unfamiliar with the financial hierarchy, let me clarify who this individual is. He's not entry-level. He's not middle management. He was the architect of the operation. He controlled the largest order flow in the Western Hemisphere from the biggest desk at the most powerful bank. He had his finger on the trigger. Today, his desk is empty. Badge deactivated, phone disconnected. The official statement, the narrative Goldman is feeding the press, is laughable. They claim he left to pursue other opportunities. They're hinting he was recruited by a hedge fund. They want you to believe that during the most violent, profitable, historic commodity surge since the 1970s, the man in charge just decided to walk away. Nonsense. You don't leave the table when the pot is this large. You don't exit Goldman Sachs mid-supercycle unless security escorts you out. Let's identify this accurately. This is a margin call termination. You destroyed the book firing. Here's the likely reality inside that trading room. Traders like Lane are trained in a specific ideology. They believe in mean reversion. They believe markets are elastic. If price rises too fast, it must snap back. So when silver hit $80, what did he do? He shorted it. This is irrational. I'll sell here, buy back lower. At $90, he probably doubled down. Retail is wrong. I'm Goldman Sachs. I'll crush them. At $100, the pressure mounted, and when it hit $100 this morning, the elastic didn't snap back. It snapped his position. You need to understand the scale of losses involved. Goldman doesn't trade 10 ounces. They trade 10 million ounces. If you're short 10 million ounces and price moves against you by $30, you've just cost the bank $300 million in a week. That's not a bad trade. That's a catastrophe. The kind of loss that makes risk managers panic. The kind that gets you terminated before lunch. This is the banker purge. Lane is the first casualty, but he's the warning signal. His exit reveals the banks weren't positioned for this. They weren't long and prepared. They were short and wrong. They believed their own narratives, that inflation was temporary, that the dollar was invincible. They bet everything on it. Now they're discovering the market is larger than they are. You can't short a currency collapse. Consider the psychology of remaining traders right now. You're at the JP Morgan desk or the Citi desk. You see Goldman's chief just got fired for fighting the trend. What do? Do you keep shorting? Keep trying to suppress price? Absolutely not. You're terrified. You don't want to lose your bonus, your job. So you stop shorting. You might even start buying to protect yourself. This is how a short squeeze becomes institutional panic. Fear of termination is now driving price higher. Traders are switching sides to save their careers. This is why price is accelerating. The human barrier that normally caps rallies, the arrogant traders selling paper to stop momentum, has been removed. They're being carried out in metaphorical body bags. The resistance is gone because the resistors are broken. And while the West fires traders and closes banks, the East is doing something completely different. The East isn't watching charts. They're watching vaults. And the price action from Shanghai overnight isn't just a rally. It's a system malfunction. A move so violent it looks like an error. We need to discuss $122. We need to examine the limit-up explosion dragging the entire world into a new paradigm. While bankers in New York pack their belongings and retail investors in Canada stare at sold-out screens, the real event, the development that effectively ends Western financial dominance, is happening 7,000 miles away. Look at the numbers from China. What happened overnight on the Shanghai Gold Exchange and Shanghai Futures Exchange isn't trading. It isn't a rally. It's teleportation. We've received closing data, and it's the kind that breaks algorithms. Silver in Shanghai didn't just rise, it exploded. It closed up 12.78% in a single session. The price, $122.95 per ounce. Let me repeat that for the traders at COMEX struggling to find metal at $114. $122. That's a gap of nearly 9 per ounce between paper price in New York and physical price in Shanghai. This isn't some illiquid secondary market. This is the largest physical consumption market on Earth. This 12% move is effectively a limit-up event, the market screaming that fiat currency is worthless. And silver wasn't alone. The entire precious metals sector in the East went vertical. Gold closed up 3.6%, breaking through to $5,113. Platinum, the industrial sleeping giant, woke up and rallied 9.68% to $3,127. This is sector-wide panic, a get-me-out-of-paper currency stampede. Chinese investors, industrial buyers, solar manufacturers, they're not asking, is it overbought? They're looking at the yuan, looking at the dollar, and saying, it's going to zero. Buy everything physical. But price is just the symptom. The disease is vault drainage. We track Shanghai Futures Exchange inventory daily. Today, another 7.3 metric tons of silver were withdrawn from registered vaults. Gone. Loaded onto trucks. Driven away. Total inventory in the Shanghai network is now down to just 18.4 million ounces. Understand how small that number is. 18 million ounces. That's less than what JP Morgan claims in a single vault corner. That's enough to supply Chinese solar industry for maybe 2 weeks. They're running on fumes. When a market runs on fumes, price stops being linear. It becomes exponential. It goes vertical because the seller knows they have the last bar. If you want the last bar of silver in Shanghai, you don't pay $120. You pay whatever the owner demands. Tomorrow, that could be $150. This $9 spread between Shanghai's $122 and New York's $114 is the death signal for Western short positions. It creates a super vacuum. Why would a Swiss refiner sell a bar to London for $114? They wouldn't. They're capitalists. They'll put it on a plane to Shanghai and sell for $122. This means the West is being starved. Metal is flowing east and never returning. The banker purge at Goldman Sachs happened because they were shorting a market being drained by a vacuum they couldn't control. They were betting against physics. Here's what the Shanghai Premium tells us about global structure. The paper markets in New York and London, COMEX and LBMA, are dying. They were designed as price discovery mechanisms, but when physical disconnects from paper by $9, the mechanism is broken. The real price is now set in Shanghai. The real price is whatever Chinese industrial buyers will pay for actual metal, and that price is $122 and climbing. Western institutions shorting at $114 aren't just wrong on direction. They're wrong on reality. They're selling a fiction while the East buys substance. This arbitrage gap cannot persist. One of three things must happen. Option 1, New York price rises to meet Shanghai. COMEX traders capitulate, cover shorts, and let price run to 122 plus. This creates the short squeeze of the century. Option 2, Shanghai price falls back to New York levels. This would require Chinese buyers to suddenly stop buying, industrial demand to vanish, and Eastern vaults to magically refill. Not happening. Option 3, the markets completely decouple. Shanghai becomes the physical market trading at real prices. COMEX becomes a paper casino disconnected from reality, eventually collapsing into irrelevance. We're watching option 3 unfold in real time. The Eastern markets are establishing price sovereignty. They're saying, we have the factories, we have the demand, we have the vaults, we set the price. And the West? The West has empty vaults, terminated traders, and suspended retail platforms. The power shift isn't coming. It's already here. So what does this mean for you? What does it mean when a Tier 1 bank suspends sales? When Goldman fires its precious metals chief? When Shanghai trades $9 above New York? It means the window is closing. Not slowly, not gradually, violently, right now. While you're watching this video, let me paint the picture of what's coming in the next 30 to 90 days. More banks will follow TD's lead. They'll call it temporary suspension due to high demand. It won't be temporary. Once they close the window, it's not reopening. They have no metal and no way to get metal. More traders will be fired. More desks will be shut down. The institutional short squeeze will intensify. As fear spreads through trading floors, the remaining shorts will panic cover, sending price into a vertical climb that makes this week look calm. The Shanghai Premium will widen. $9 today, $15 next week, $25 the week after. Eventually, Western paper markets will become so disconnected from physical reality that they'll simply stop functioning. Price discovery will move entirely to the east. Industrial users in the West will start to panic. Solar companies, electronics manufacturers, medical device makers, they all need silver. When they realize the supply chain is broken, they'll start paying any price. We're talking $200, $300, $500 per ounce for industrial contracts. And here's the critical part. Retail will be completely locked out. You think it's hard to buy silver today? Wait 2 months. The only silver available will be in private hands. The guy who stacked at $20 per ounce 5 years ago, he's not selling. Or if he is, he wants $400 per ounce minimum. The people sitting on cash right now, waiting for a dip, waiting for a correction, are making the costliest mistake of their lives. They're operating on old programming. They think, markets always pull back. I'll wait for a better entry. That logic worked when markets were functioning normally, when banks had inventory, when refiners had capacity, when the East wasn't vacuuming up every available ounce. That world is gone. We're in a new paradigm where availability matters more than price, where having metal matters more than having the perfect entry. Let me be direct. If you have the ability to acquire physical silver today at any price, you should seriously consider it. Not as investment advice, I'm not your financial advisor, but as a read of the game board. Because what we're watching isn't a market cycle, it's a market phase transition. The old rules don't apply, the old playbook is obsolete. The people who understand this, who see TD's suspension not as a temporary glitch, but as a permanent regime change, they're acting now. The people who don't understand it, they'll spend the next 6 months watching price climb while desperately searching for anyone willing to sell them metal. And they won't find any. This is the great separation. On one side, people holding physical assets, real money, silver, gold, platinum, things you can touch, store, and control. On the other side, people holding paper, dollars in bank accounts, promises from institutions, numbers on screens that can't be converted into anything real. The gap between these two groups is about to become unbridgeable. Here's my final message. The system is showing you what it is. TD Bank is showing you they can't deliver metal. Goldman Sachs is showing you their traders bet wrong and got fired. Shanghai is showing you the real price is 120 taos, not $114. These aren't isolated incidents. They're signals. The system is screaming at you in every language it knows. The paper window is closing. The conversion mechanism is breaking. The ability to turn fiat into real assets is ending. Most people won't hear the signal. They'll keep their cash in banks, keep waiting for pullbacks that never come, keep trusting institutions that have nothing left to give them. But you're watching bullion IQ. You're paying attention. You see the patterns others miss. So the question is simple. What are you going to do with this information? Are you going to wait? Hope things calm down? Assume the old rules still apply? Or are you going to recognize this for what it is? The final call before the window slams shut permanently. The choice is yours, but choose quickly, because TD Bank just showed you. There's no guarantee the buy button will still be there tomorrow. Thanks for watching Bullion IQ. If this analysis helped you see what's really happening, hit that subscribe button. We decode the signals the system doesn't want you to see. Until next time, stay sharp, stay prepared. And remember, in a world of paper promises, physical assets are the only truth that matters.